Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and on this episode, we're going to talk about interest rates going up yet again and why it's going to be even more challenging to qualify for a mortgage, especially if you're looking to buy in this market. Stay tuned, you don't want to miss it. For those of you watching on the Team Sessa YouTube Real Estate channel, once again, thanks for clicking and thanks for watching. Don't forget to share the video. Don't forget to hit the like button. And if you're not subscribed to the channel, it's free. Click the subscribe button. Don't forget to hit that notification bell. And if you want to book a free consultation with myself or Santo, you can do that in the description box below as well. But now back to the video. Qualifying for a mortgage just got more challenging in Canada as interest rates on the fixed end begin to rise. Yes, I said it, fixed rates are up again from just last week. And on the tails of what the Bank of Canada had done by bumping up the policy rate 0.25%, leaving the door open for a potential increase yet again on July 12th, before they break for the summer months and reconvene in September, it can leave a lot to be desired for Canadians who are looking to enter into the market. Do you go back to the sidelines? Do you end up buying? That is the question we get often here at InTouch Mortgage Solutions. Now, obviously, although we can't tell clients when to make a decision on whether or not they should or should not be buying, a lot of Canadians over the course of the last little while, especially when interest rates started to come down in May, were locking in those pre-approvals. And those pre-approvals seem to be a really good idea, especially when you look at where the rates were and where they are now. And we'll talk a little bit more about that, and I'll show you where the rates are in just a moment. But obviously, when we look at the Bank of Canada, its current recent ability to potentially raise again in July after it just raised 0.25% is pretty shocking when you think about the Bank of Canada historically. You know, we've always seen the Bank of Canada raise rates and then sort of pause and then decrease rates. What we've seen right now is the Bank of Canada increase, pause, and increase again. Obviously, there are some things that we need to take into consideration. Average home price in Canada jumped to $715,000 across the board. Obviously, depending on where you're looking, that might seem like a really good price. But obviously, if you're buying in Vancouver, Toronto, prices could be much higher than that. And obviously, when you take a look at Canada as a whole, well, many Canadians can buy with just as little as 5% down, just not in those hotter markets. Why is this important? Well, obviously, we take a look at different components, especially in Ontario, in Vancouver, rental markets, purpose-built homes, even homes to be bought. We're starting to see some indication from developers that they're starting to slow down, especially as interest rates and the cost to build increase. And even though many municipalities like Toronto and Ontario have made some amendments to allow more development, well, those particular issues when it comes to supply can take months, if not years, to actually bring inventory to the market. So it's obviously putting a lot of pressure on buyers today. And as we start to see lower inventory numbers, we don't see those multiple homes coming to the market. It starts to dry up as a result of the the banks potentially helping clients stay in their homes, whether that means increasing the amortization and adding back some of that principal that they would have been owed, or the interest back to principal, I should say. You know, there are a lot of things that we should be considering. Importantly enough is obviously the Canadian household debt. According to CMHC, Stats Canada, Canada is one of the most indebted nations in the G7. And obviously, economic pressures from that have rippling effects if we see job losses, which the Bank of Canada wants to see. They want to see less jobs, want to see higher unemployment. All these things could spell a disaster, especially for Canadians who are on the lower end of the income earning spectrum. So this is very important to keep in mind. So why is all this important when it comes to interest rates? Well, potentially this could help cool or slow down a lot of the demand in the housing market, like we saw over the past little while. When we saw the Bank of Canada on its warpath to increasing policy rate, well, that definitely dampened demand, I should say. Obviously, because we had some homes hitting the market, there was a limited supply at that time, but obviously it took a lot of the steam out of the engine. And now that we saw interest rates sort of coming down, that sort of brought a lot of new attention to the housing market. We start to see those prices surge. So now as we start to see those fixed rate mortgages tick back up, well, obviously this could slow down the market. But I have an inclination on the fact that many Canadians during this period got pre-approvals. And like we've seen over the past with pre-approvals at a good rate, a lot of times Canadians are going to try and execute to get that rate. Just because you can doesn't mean you should. And we tell clients that all the time. I mean, obviously, you know what you're qualified for. Should you go to your max budget? That's a decision that you and your household should be making. We always tell our clients it's important to marry the price of the home, but date the rate, because as those rates change, obviously it could spell thousands and thousands of dollars in savings. As purchasing a home at a lower price, even if you're paying a little bit more in the interest rate, generally don't compute. We've had a client in the recent weeks who purchased a home several months ago. It was about $70,000 less than what the exact comparable sold for today. And even though their interest rate was slightly higher than the person that potentially would have got their mortgage today, well, over a 3 or 5 year window, there's no way that you're making that $70,000 gap. And obviously that's up for debate. This was just a scenario and a conversation that we had. But let's get into these rates and see exactly where they were just a few short weeks ago. So as we take a look at these rates, we sort of see that back in May, in the middle of May, we were looking at a 5-year insured mortgage at around 4.39%. Fast forward through June, and right now that exact 5-year insured mortgage is at 5.09%. That's a 60 basis point swing in just a few weeks. And even for the conventional rate mortgages from 4.94% up to 5.54%, that's another 60 basis point swing. 3 years, which were the very common place for many Canadians who are looking to either renew or purchase a home, opting for the shorter term mortgages, while those mortgages saw the biggest jump. 3-year insured went from 4.99 all the way to 5.54. That's a 65 basis point jump. And on the conventional end, obviously those are the 30-year mortgages as opposed to the 25-year AMs, default insurance premiums, and obviously limitations on purchase price for insured mortgages under $1 million. While the conventional went from around 4.99 to 5.71, which is a 72 basis point jump. So those Canadians who may have locked in earlier, obviously those pre-approvals are floating around. What this will do to the housing stock, what we'll do for the current little while, obviously the Bank of Canada wants to see things slow down, this exuberance sort of come back down to earth. We want to get inflation back down to 2%, but Canadians with a good rate may tend to execute if they got that pre-approval. And that's sort of what we're seeing right now is we've been notifying clients saying, hey, look, if your pre-approval is coming up for for maturity, I should say, because there's a 120-day window, you know, many clients have to understand that within that time frame, you do need to execute on the purchase in order to get that rate. And obviously, speaking to your mortgage professional about options and solutions when it comes to your pre-approval, what it means for you, how to make sure that you are best prepared to go out there and purchase, especially in this environment, can help keep thousands of dollars in your pocket. So now with all those interest rates being explored, obviously you see that there's been a bump. Now, what does this mean for Canadians looking to buy a home, right? Well, obviously in Canada, we have a stress test rule, right? The B20 guidelines that 2% plus on the contract rate. So if you're new to the channel and maybe this is your first time, you know, exploring your options when it comes to buying a home, well, obviously if you have a contract rate of, let's say 5.09%, that's the rate that the lender's quoting. Well, you have to qualify on that rate plus 2% at 7.09%, which means there's obviously some limitations on the amount of mortgage that you can take on from 5 to 7%, right? That 2% bump. And for many Canadians right now, especially those looking at their options, the difference between, let's say, a 1-year and a 5-year product, right, on the qualification end, right? So it's not just the mortgage amount, it's obviously a 25-year AM. I've used some parameters like $150,000 combined income, hypothetically no debt, and obviously this is a good thing, but this is for illustration purposes only, and it can show exactly what the differences are. So if you're looking at a 1-year product, let's say you're at around 6% versus a 5-year around 5%. Well, because you have to qualify plus 2%, it could mean a $48,000 difference between going for a 1-year product and a 5. And between a 3 and a 5, it could mean around $23,000 difference. That's $23,000 less of a mortgage that you qualify for with the current higher rates. So that's important to understand. Now, with that being said, what does this mean for Canadians? Well, a lot of times, as we talked about, and as the Bank of Canada and a lot of the lenders have picked up on, well, Canadians were opting for the shorter term 1, 2, 3-year products. But as the bond prices continue to surge, those prices for shorter term financing gets more expensive. So for qualification, you may have wanted a 1 year or a 3 year or a 2 year product, but you might be forced into taking a longer term, like a 4 or 5 year product, because of the qualification. So this is an important conversation we're having with clients who are looking to up their purchase price. And when you're running these scenarios to keep these numbers within ratio for particular deals, remember, depending if there's an exception or a discretionary pricing or so on and so forth on the product, you have to keep those numbers within limit. And maybe making that purchase, maybe you paid a little bit more, you wanted to win that property, as some Canadians are doing in these multiple offers in these situations right now. And we're not talking, crazy amounts. I know there's headlines with, paid X amount over asking, but obviously that's the list price and there's a sale price, right? If they listed that home hundreds of thousands of dollars cheaper than the actual price that the home is worth in the market, not just because of the listing, but that's what homes are going for. Well, they actually use this over asking price. Now, let's not get into my thoughts on that, but obviously it's important to understand, you're in a multiple situation, you might come up 10, 15, 20, $30,000. So the gap between a 1 and 5, $48,000 hypothetically for illustration purposes. Between a 3 and a 5 could be $23,000, meaning, you may end up selecting that 5 when you wanted the 3 just to get through the door so that you qualify. Before we end the video off, just a reminder to all our viewers, if you're not subscribed to the channel, we kindly invite you to subscribe. It's free, just smash the subscribe button. And while you're there, don't forget to hit the notification bell. Helps us and you get notified every time we post a new video. And as we mentioned, make sure you leave a comment down below. And if you found something helpful or you think someone that may benefit from the content that we're producing here, don't forget to share the video with them. But we'll leave the video here, hoping everyone has a great Friday and an even better weekend ahead. We'll see you next week. Thanks for clicking.